If not, I'll just post the recording in there. So, Luke, what's up, man? Hey, everybody. This is Hayden. You guys know I'm the author of Skip the Flip. I got my buddy Luke here, a recent friend and kindred spirit, because he is a real estate beast, but in a different field, right? Luke, I'll let you talk about your real estate investments. But what I love about him is he's a service provider. He understands the financial component of how real estate deals work so well, and he uses that knowledge to benefit the people who work with him and help getting loans. He can fully understand, explain how every single thing works. So what I thought would be really helpful, Luke, is to get you on, because you can talk about what you do and why you're in a better position than just a lender who works at a bank to understand the full breadth of the lending market and lending environment right now. So I'll let you explain kind of what you do, both on the investment side, also on the lender broker side. And then I want to open up and I want to hear some people's questions about, hey, I heard my banker, blah, 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 blah. And we're going to try and overcome those and tell people, hey, deals are getting done right now. It's not an excuse that you can't get a loan to not be investing in real estate, because plenty of people are getting loans during this time. You just got to know what levers to pull, right? So with that being said, I want to turn it over to you and just kind of let you take it from here.
Yeah, absolutely. Thanks, Hayden. So a little bit about me. My name's Luke Safranek. I have been working at Berkadia Commercial Mortgage for about 6 years. We're the biggest combined Fannie, Freddie, and HUD lender in the country. So we do a ton of basically government-backed loans on apartment buildings. And we do about $25 billion a year. I'm out of our Detroit office, and we do about $1 to $2 billion a year out of our Detroit office here, financing any type of real estate. So definitely a focus on multifamily with Fannie, Freddie, and HUD, but we will finance anything, and that includes mobile home parks, retail buildings, office buildings, self-storage, you name it, we probably have a lender for it. And honestly, these days I've been very popular because it's definitely tougher to get loans now than it was 6 months ago. So the good news is interest rates are absurdly low, lower than they've ever been. It doesn't even make sense. The yield curve is essentially flat. So I was looking at it today. You can get a 30-day LIBOR is at 0.15%, and the 10-year Treasury is at 0.66%, and even the 30-year Treasury is at 1.4%. So you're sub 1% almost for any type of index that you're looking at in terms of bonds. So it's just incredibly low. So rates are low, which is great, and we're closing loans in like the low 2s with HUD and the low 3s with Fannie and Freddie and other lenders, which I'll talk about as well. But the bad news is everyone is pickier these days. So so what I do is for Fannie, Freddie, and HUD, Berkadia is the direct lender. We're the ones actually making the loans. It goes through our credit committee. We're the ones trading the bonds, everything. And then for everything else, I'm essentially a broker. But I do have some correspondent relationships with a bunch of life insurance companies that you couldn't go to directly. So a lot of people, people send me a deal and I say, hey, this is a good deal for your bank. I'll tell you, like, if you have a local bank, probably the best way to go. But a lot of times I have life insurance company lenders and CMBS lenders and other alternative lenders that you might not even know about. So what's happening these days is people are going to their local banks and they're not getting the deals that they used to get, or they're not getting the deals that people told them they could get 6 months ago, because everyone's just being pickier.
But why is that, Luke? Why is everybody being pickier right now?
Uncertainty, and it's amazing. Everyone calls me and say rates are super low. I want to refinance, and I'm like, well, hold on. Just because rates are low doesn't mean anyone wants to do your deal, and it's for a couple of reasons. One, there's a lot of uncertainty with COVID. How bad is the economy going to get? How banks are reserving tons of money for loans they think might go bad. These loans haven't gone bad yet. And remember, it's business loans, real estate loans. I mean, anyone who has exposure to the hotel industry is super scared right now. So lenders are basically looking at all these business loans and real estate loans in their books and saying, we think a lot of these may go bad in next year. We're going to preemptively reserve a ton of money just in case they do. So they're like, do we really want to be going out and looking for new business when we're busy kind of dealing with the books we have on our, or the loans we have on our books already? So they're granting a lot of forbearance requests. They're working with all these existing loans on their portfolio. And so they're busy with that. They're busy with the PPP loans, or at least they were earlier this year. And there's election uncertainty. and there's COVID uncertainty.
Okay, so what it sounds like is you're not doing any loans. Is that right? No loans are getting done?
Absolutely not. Loans are getting done. They're just not getting done in the 6 months ago, everything was getting done. It was easy to get loans done. Now it's harder. Lenders are definitely more conservative, but the bottom line is they still are getting done. So for example, I had a 100% occupied, recently renovated multifamily deal that should have been an easy Freddie Mac loan. And Freddie Mac basically said, the sponsorship's not very strong. I'm like, this is an easy loan. So Fannie, Freddie, and HUD, most life insurance companies do what's called non-recourse loans. Someone who owns a property 100% by themselves, they usually say, hey, I own this property 100%. I believe in it. I'm willing to sign personal recourse on this loan. If there's a bunch of partners on a loan and the partners aren't equal partners, where one guy owns 10%, one guy owns 15%, one guy owns 5%, none of them want to sign joint and several recourse, because if the loan goes bad, whoever has the most money at that time is the one the bank's going to go after. So non-recourse loans become very important when you're syndicating deals or you have a lot of partners. So for those non-recourse loans, since they're non-recourse, lenders usually care more about the property and the property cash flow than the sponsorship. Sponsorship is still important, but the property cash flows are even more important. So what they said on this deal is, hey, listen, the sponsorship's not very strong. And I said, who cares? The deal is really strong. And they said, right now, we can be picky. We're seeing a lot of deals. CMBS lenders aren't in the market. Life insurance companies are being very conservative. We can basically have our pick of what we want to do. And if they said this sponsor should go to a local bank or a credit union and go get the deal done with someone else, he's going to have a worse interest rate. He's going to have a shorter amortization. He's going to sign recourse. Once he has 2 or 3 deals under his belt, then we'll think about it. And it was very surprising because it was a great deal, but their lenders are very sponsorship focused right now.
So could that particular individual, could they have gone out and gotten somebody who had that track record under their belt and essentially told them, hey, I'd like to partner with you on this deal, and borrowed their track record to get that loan done?
100%. He could have brought in a partner. He could have brought in someone who was willing to sign on the loan and basically vouch for him to get the deal done. The question is, what do you give up to get that guy to sign? Putting your name on a $5, $10, $15, $20 million loan is a scary thing. Even if it's non-recourse, I mean, you're putting your name on the carve-outs. So the bad boy acts, fraud, misrepresentation. Like, if anything happens that is a little bit shady, that lender is going to come after you personally. So sure, he could have found someone, but the question is, what does he have to give up for that person to sign? That's always the question.
The question is, though, right, if you've got this fantastic deal, it all comes back to the deal being good. If it's that good, are you willing to give up 15, 20% of the deal, or would you rather have no deal whatsoever, right?
Right. And in this instance, he said, you know what, I'll just stay with my current loan. My back's not up against the wall. Some people have maturing loans. I'll give you another example. I have an office deal right now. Lenders are very scared of hotels, office, and retail right now. They love apartments and they love self-storage. Self-storage is what everyone wants to see right now.
Sounds like a smart play, man. You guys should do some self-storage. You know what I mean?
It does. You should think about that. I know a few people that do it. So right now I have an office building where everything that lenders are scared about is actually happening. So these guys came to me and they have a 100% office building in a great location with like 20 tenants, very solid tenants, beautiful build outs, and the loan is maturing. And the current lender basically said, we don't want to refinance this deal. We don't like office space right now. We don't want to do office at all, just period. So go refinance it. Unfortunately, he had a bunch of leases that rolled during COVID. And what everyone's worried about is, with everyone working from home, are people going to come back to the office? Are people going to re-sign leases? Are they going to take less space or no space? Or are they going to shop around for a cheaper building? Everyone's worried about that. So it's actually happening in this building. The tenants are not willing to re-sign longer leases. So they're on month-to-month leases. So even though the building's 100% occupied, cash flowing, the debt's probably at 50% LTV, since these tenants won't re-sign leases, the borrower is kind of screwed because he doesn't want to kick them out and then go look for other tenants to try to backfill the space and deal with all that hassle. But they won't sign a long-term lease. So he has a maturing loan that the lender doesn't want to give him an extension on. So I'm out right now.
Even his same lender, right? You're talking about the lender who currently has the lien?
Yeah, the lender that currently holds the debt does not want to give them an extension. Well, and the extension that they proposed sucks, honestly. It's not a good deal. It includes loan pay downs, reserves, etc. I'm out looking for a bridge loan, and it's like rarely do I look for a bridge loan on a property that's 50% LTV and 100% occupied. But that's what's going on right now. Lenders are they're being picky, they're being cautious, and they really they're getting deals done, but at lower leverage, with more reserves, very focused on sponsorship. And honestly, that's why I'm popular, because a lot of people just aren't even lending right now, or their terms aren't so good. So everyone's calling me and saying, hey, my bank said they were going to give me this a year ago, but now that deal's not on the table. What can you find for me? And I say, hey, who have you sent to? And I can go out there and send it to people who I know are actually lending.
Yeah. So tell people, you keep saying this is why I'm popular, and the people on this call may not understand why you're popular and why you're different than just some other bank in this office example. Why are you any different than that person's lender? I understand, but explain to these other people why you're popular.
Right. Because each individual lender likes different things. So if you're just talking to one or two local banks, they're both competing for the same deals. They both like the same exact food groups, and they both have kind of like a set group and a set idea of what kind of loans they want to do. I'm able to go out to the market and find the perfect lender for your deal. So I'm not just talking to one or two lenders. I'm talking to 30 or 40 different lenders, each with different food groups that they want to do, different terms that they're going to offer, and I can go out and find the best loan for your deal. And
all those lenders like getting phone calls from you, right? Because they know that you're not wasting their time, that you have a deal that's going to be of value to them, right?
Right. When I send them a deal, I'm not calling them up, hey, let's go, sending them, one pager, a picture of the deal, or some numbers. I am sending them a full package. So when I underwrite a deal, I basically do all their work for them. I'm putting together all the profit and loss statements, rent rolls. I'm putting together market reports. I'm putting together rent comps, sales comps, demographics. I'm putting together a whole package, and in one succinct 10-page document, they can see everything they need to see about the loan. They don't have to do any more research once I've done it. I essentially do an appraisal for free before the appraiser does it. And I'll even call appraisers and say, hey, does this make sense to you? If I send you this deal after we sign it up, do these numbers make sense to you? An appraiser they'll say yeah, they'll say no, we think the cap rate's too high or too low, or here's another sale comp that you don't have. And so when I send it to lenders, they're getting a full package and they're getting everything ready to go, and it's easy for them to say yes or no. So they're going to take the time to look at it and give me some accurate feedback.
Gotcha. That's awesome. So talk to me about a couple, even on what I'm hearing from you is you have to be more specific about what kind of deals you want to do, right? We can't just say, we're going to do commercial. It's like, all right, you need to pick a kind of commercial deal that lenders want to lend on right now is number one. Talk to me about different markets. How important is where the property is located to the lenders right now? I mean, are people wanting to lend in California and New York due to these long, eviction push outs, or do lenders not really care? Talk to me about that aspect of it.
There's only three things in real estate that really matter, and that's location. So they're always very location specific. But that being said, you're right. The big cities right now are really struggling. People are worried that, we've seen it. Rents are dropping significantly in San Francisco and New York. Lenders are absolutely scrutinizing that. They're looking at their portfolio. They're looking at market comps. They're reading articles, and they're saying, yeah, do I really want to do a full leverage loan right now in San Francisco where this guy is in the lease up period and he's projecting rents at $5,000 a month and he's only leasing them up at $3,000 a month? Lenders are going to look at the numbers. So the numbers really matter. If rents have gone down and the numbers still work, then the numbers still work. But that's why they have multiple different metrics. They're going to look at occupancy. They're going to look at debt service coverage. They're going to look at the debt yield. They're going to look at all these different metrics to determine, and they're going to use stress tests. They're going to use a high, even though they might be giving you a 3.5% interest rate, they're going to use a 5 or a 6% interest rate to stress the loan and make sure that it still works, even if you lose, let's say, 10% of your tenant. So
Mm-hmm.
they'll still do deals in those markets. I mean, location absolutely matters, but the numbers matter as well. So yeah, they'll do deals anywhere. There's not lenders that are saying we're not doing deals in Michigan or we're not doing deals in
Mm-hmm.
Las Vegas, but they're just saying, hey, we're going to treat those deals more conservative.
Gotcha. So from a reserve perspective, and for people who don't know what that means, is up front, you got to set aside a certain amount of money to service this debt. Tell me what you're seeing and what everybody else can kind of prepare for on the reserve side of things, to where if they want to go out and get this loan, how much they underwrite into the deal that they're going to have to set aside. I know it varies lender by lender, property by property, but just what are you seeing in the market for different asset types on the reserve side?
Yeah, the rule of thumb right now for apartments is essentially 1 year of amortizing debt service held back up front. So what they're looking for is everyone wants to, let's say someone's giving you a 75% loan to value loan on a purchase. So you're like, all right, I only need to bring 25% down payment.
Mm-hmm.
Well, what you're forgetting is these days, because of COVID, everyone is making you have upfront reserves. So they're essentially saying, we want 1 whole year of your debt service payments held back up front. So now that 75% loan may be 70%. That's extra equity, even though it's your money sitting in escrow with the lender. One, you're paying interest on it and you can't use it. And you're going to need to bring more money to the table to
Mm-hmm.
cover that. Because if you're buying a property up front, all of a sudden, even though they say it's 75%, they're only giving you 70% of the money because they're holding back X amount of dollars. So that amortizing debt service holdback, really can kill deals because you need to raise extra equity to get that.
Yep.
And then you do get that money released, usually after 2 quarters of hitting a certain minimum debt service coverage ratio, you get that money out. So, and listen, if it's a really good deal with a really good track record, can you get it down to 9 months of debt service or even 6 months? Yeah, I just did one where they only took 6 months of debt service coverage of debt service because, they felt this was a strong deal, great deal. The metrics were good going in and they didn't need to take a full year. But,
And
be prepared for lenders.
You can't pull out of that escrow to make your note payments for a year, right? You got to use the operating capital and the cash flow from the property to pay it. That money's going to sit in there in full until that threshold of 2 quarters, 6 months, a year, whatever is agreed upon. Is that right?
This is not an interest reserve. They're not holding it back and then using it to pay their debt payments. They're holding back this money because they're worried that in the next 6 to 12 months, your property might be struggling and they might need it. There's just a lot of uncertainty right now. No one knows what's going to happen because, Congress came in and had the huge stimulus package and everyone was able to make rents. Anyone who was unemployed was able to make rents. Now you have an eviction moratorium, so people can't, a lot of times you can't evict tenants. And if they're not, and that stimulus package is over, so if they're not making enough money on unemployment to pay for their unit, you're stuck with a tenant that you can't evict and they can't pay. And everyone's worried that could be worse, depending on what Congress does.
On the same side, are your lenders legally allowed to foreclose right now?
Yeah, they can foreclose, and they're not messing around. I mean, I've had guys who they were easy on these guys. They don't want to foreclose. They've been handing out forbearance. They've been giving people forbearance. So it's not like they're just totally screwing someone over if they can't pay debt service. If someone owns a retail strip center and half your tenants or even all of your tenants aren't paying or asking for free rent because their stores aren't open because of COVID, the lenders they don't want that property back. So they're going to say, all right, you take 6 months of no payments and then come back to us 6 months later and let's see where you're at. Lenders learned their lesson from 2008, 2009, where they came in and they foreclosed left and right. And then they tried to, resell those properties and they ended up getting killed when they sold them for less than they had loaned on those properties. So everyone started foreclosing and then everyone was trying to sell. And there was just a huge glut of properties that ended up declining in value significantly. They learned their lesson from that and they don't want to go through it again. So it's much easier to get forbearance these days if your property is struggling. But they will foreclose. I mean, they make the terms. If you're in default of your loan, the lender, they tell you how it's going to be. And the best example is this office deal I'm dealing with right now. The lender's like, listen, put $200,000 in reserve, pay down the loan by $200,000, and, we'll think about giving you a 6-month extension.
So you're
Otherwise,
a savvy.
we'll foreclose.
Yeah. Yeah.
Foreclose.
So you're a savvy dude, right? I mean, all you do all day is you look at who's giving loans. I mean, you have inside access to essentially the smartest minds in real estate, because you're looking at people who are making these loans. You're understanding and getting insider information on why they're making this loan versus that loan, how they see the risk profile. But you're also an investor, right? So tell me Luke's personal opinion on what are you doing with your cash, and what are you currently looking for deals and investing in certain kind of deals, or do you see this glut of office space and you're gonna be like, man, I'm gonna go convert a bunch of office space into apartments in 2021 whenever these guys fail? Tell me about, just from your investment perspective, where are you at?
Yeah, different investors have different parameters and different things they're looking to achieve. Like institutional money is always the cheapest money because they're the ones that want just stable properties. They're willing to pay a low cap rate. Right now, since interest rates are so low, if you can get debt, and someone who was paying a 6% cap rate last year, they said, 6% is too low because their debt was going to be 4%. But now they're paying a 6% cap rate and your debt's at 3%, all of a sudden your returns might make sense. So with the low interest rates right now, deals that were just okay now look a lot more attractive. For me personally, I don't want to be the one following the crowd. Real estate is very cyclical, and just because hotels are not doing well right now doesn't mean hotels are going to do badly forever. Just because people are worried about office right now, that does not mean that people are not going to come back to the office. So I'm always looking for deals. I've invested with a few of my clients. I've bought some stuff on my own. I actually, I throw some lowball offers on stuff, and then when I hadn't won anything in the last couple of years, and now I'm starting to win deals, and I'm asking myself if I'm the idiot. These days, there's so much competition. Whenever you win a deal, you got to ask yourself, how did I win that deal? Maybe I'm missing something.
What am I missing is always, when you win a deal, when there's other people, you always go, what am I missing, right?
Right, exactly. So, cap rates haven't changed that much. I haven't seen a lot of deals because the stuff that is worrisome out there and not performing very well, the hotels and retail space, all the borrowers are getting forbearance. So they're all in forbearance, so they're not desperate to sell yet. And everyone thinks things are going to come back. So there hasn't actually been a glut of sales on the market. But I will say I'm starting to see deals out there that people are getting worried. People are seeing rents going down. People aren't able to lease up. So yeah, I'm looking at office, but it has to be the right deal. You need to make sure. If you read Hayden's book, he talks about making sure that the numbers work, and that's so important to do your due diligence up front. And let's say you're buying an office deal, you can't just look at it on a straight cap rate. You got to remember, if you need to re-tenant it, you're spending a ton of money on tenant improvements, leasing commissions. You're going to have 6 months of downtime while you're out marketing it. It's not as easy as looking at here's the NOI from last year, put a cap rate on it. That's what you should pay for it. You got to really realize what kind of return you want to make and how much money it's actually going to cost to keep this building running and in good shape and keep your tenants. So I'm always looking. I always tell people if it's a good deal, I'll buy any type of real estate. But you are right. It's good to focus on one or two types and not diversify too much because there's
well, you're in a great spot. You're in a great spot to be able to see this, right? Because you underwrite every type of real estate, and that's all you do all day, right? For a lot of people, they're not spending their 100% full times underwriting deals and then taking it to professionals in that niche and having them tell you, no, your reserves or your operating blah, blah, blah is way off here, right? Because you're learning those lessons. I mean, you probably learn more on so many different types of deals just at an accelerated pace compared to where most people, they're learning at this slower rate and they're not getting that feedback until they actually go out and do it and see it for themselves versus you've kind of had, what is much more powerful than an actual college experience. So
right, exactly. I have a huge advantage in that every single day I'm looking at tons of different real estate types. So I more or less understand, I've seen pro formas, I've seen appraisals, how all the different real estate food groups work. Whereas, if you're out there trying to be an investor or you have a day job, you don't have time to go learn how 10 different types of real estate works. I mean, I've had guys recently call me and they say, hey, I got this great deal. And I'm like, well, what is it? He's like, well, it's a senior living facility. I'm like, okay, so what experience do you have? He's like, I don't have any, but I know it's a good deal. I'm like, listen, senior living, it takes forever to lease up. It, especially with COVID, a lot of those facilities aren't doing so well. They're incredibly difficult to finance. And by the way, it's not just a real estate play, it's an operating business as well. It's the same thing with hotels. It's really an operating business as well as a pure real estate play. You don't have tenants who are in there for a year or 5 years and you're collecting rent. You guys, hotels turn over their entire rent roll every single day. Mm-hmm. Senior living, you're providing care to tons of different people. And if all it takes is one bad social media post these days, and you might lose half your tenants. So it is important to understand and pick a specific type of real estate that you want to focus on and stick with that. And listen, there's a lot of opportunities right now in retail and office and hotels, but at the same time, no one wants to lend on those things. So you really need a lot of cash if you want to go into that. So
that's a great time to come in and be creative, come up with a structure that meets the other party's needs. Hey, why do you need to sell this property? Right? Hear their position. If it's my loans being called due, then hey, maybe I can, provide some sort of loan to fit that piece. There's so many different ways, right? The excuse of I can't get a loan because I haven't done a deal in the past 3 years or my balance sheet isn't that strong. That's really not an excuse. And really the point of this call was to show people that that's not an excuse to not be a real estate investor right now, because there's so many ways you can overcome that. You can partner with certain people if the deal is good. You can come to Luke and he's going to tell you, don't waste your time with these and these lenders. They're not going to touch it. Go to this and this. You can figure out how to get creative and do those deals. But the deal needs to be right. It needs to be the right kind of deal in the right place, and the numbers need to make sense. And the financing piece will take care of itself with a little bit of effort as long as you have a great deal. Agreed, Luke?
Yeah, absolutely. And these days, sure, you might need to bring more cash to the table. You might need to find a partner with a stronger balance sheet. You might need to get a bridge loan on the deal because it's still in lease up, or you've got a lot of work to do and you're going to pay a higher interest rate. So there are loans out there. They might not be as aggressive as they were 6 months or a year ago, but there are still deals out there, whether you're paying more to get it or it's amortizing faster or whatever it is, there are deals. They're just a little bit harder to get.
Tell me one last question before we open up to the group task questions, whatever they want to ask you. What do you see as kind of being the floodgates of getting things back to where they were? I know there's a lot of variables in our world right now. Obviously, November will be a big one. But at what point do you feel like do you think things will immediately go back to where they were, or do you think things will slowly get back to where they were, and what will start that?
Well, obviously a vaccine. I mean, if we get a vaccine that actually works, not one that people say works, but it actually has to work. And everyone all of a sudden is like, all right, we can all go back to work and everything goes back to normal. That'll be a huge catalyst to getting things back to normal. I don't think they're going to come back quite as fast as people think. I mean, everyone thought, hey, we're going to have like a V-shaped recovery here. I mean, a lot of people lost their jobs. A lot of businesses are struggling. A lot of companies declared bankruptcy during this. And everything's not just going to pop back to normal. But getting that vaccine will really, really help and give people a lot of security. That's what hotels need. That's what airlines need. For anyone involved in travel, you really need a vaccine before things are going to get even close to normal.
So you think once that vaccine, a proven vaccine hits, that again, do you think it'll be boom back to where it was, or do you think they're going to be like, okay, let's see how this goes for the next 6 months?
I think people are going to be very, very optimistic when a vaccine gets approved, and things will bounce back relatively quickly.
Yeah, I agree. And I think after we see, what happens in November, I think we also have another stimulus package in the pipeline. It's not a long-term solution, but it is, it boosts morale short-term. So cool, man. Well, what I want to do is anybody who's on this call, just unmute yourself. If you have a question about, obviously we talked a lot about commercial lending today. Luke doesn't specialize in residential lending, but it's fundamentally the same mechanics. So if you guys have any questions about a loan you're trying to get, a deal you're currently looking at, whatever a bank's telling you about why you can't do this or that, I want to squash that objection right now and get that taken care of. So whoever can unmute themselves, chime in. If not, then we're going to let Luke go because he's got some money to make, I think.
Hey, Hayden, can we get the contact information for Luke? Like to do that moving into, commercial real estate now. And, one of the hurdles that we found is definitely the lending aspect of it, and everything that you are talking about is what we've been finding. So is there a possibility we can get his contact information?
Yeah, so you're going to have to Venmo me. No, I'm just kidding. You can definitely get his contact info. Luke, what's the best way for anybody here to contact you and for you to help them get some debt?
Just email me. That's the best way. It's Luke, Luke.
Restart. Your mic wasn't working for us. And I'll post this too in
just you can give her my contact info and put it on Facebook, whatever. But it's the best way to reach me is my email, and that's Luke, Luke .Safranek. My last name, Safranek, and that's at berkadia.com, Berkadia.
Did you get that, Chris?
Yes, sir. Thank you very much.
Yeah, and they just need to shoot you an email or what?
Yep. Fine. Email is the best way.
Awesome. Anybody else got a question? There you go.
How long are you finding if you're doing a non-recourse loan, is the research on the property going right now?
Like how fast can I get it done?
Yeah, on non-recourse.
I mean, we can get, so I guess I could talk about the process a little bit. I mean, it really depends how much either the seller or the guy who's looking to refinance, how organized they are, because, the more info I can get from the seller or the person looking to finance it, the better. But once I get all of the property level information and all of the information on the sponsorship, I mean, I can get it submitted in 24 hours. I have, Berkadia we have over 500 employees in India that basically do all of our back office stuff. And if I get a package in, I flip it over to them. In 24 hours, they've sent me most of the research I need. I just need to put it together in the best way for lenders. But I can get it out to lenders in 24 hours. I can get a full package out to them as long as I have the right property level information, and I can get feedback usually in a week. Let's say a quote in 1 to 2 weeks. And once you sign it up, we can close in 45 days.
That is pretty quick. Have you, in what you're seeing right now, if you're, say, a space that has kind of been empty for a while, or and the tenants aren't there, and you're maybe looking at doing, repurposing, are banks looking at that right now, or are they kind of weary of that type of purpose right now?
Yeah, that type of deal would be tough even before COVID, and right now it's almost a non-starter. I am getting vacant retail deals financed on bridge loans with higher interest rates, and usually you have to have a really good story. You have to have a tenant in your back pocket that's close to signing, or
sign, right, Luke? I mean, a signed lease with a deposit is probably as good as somebody in there. Maybe, right? Pretty close.
Right. Yeah. If you have a signed lease and all you need money is for build outs, that's something we can get done. But if it's been vacant for a while and still is vacant, and you don't have at least, some LOIs that are close to being signed up, yeah, it's almost impossible to finance something like that. Commercial real estate lenders are cash flow lenders. They are lending on the cash flows the properties generate. So if that property isn't generating any cash flow, they really don't like that deal. They rarely are doing asset-based loans. And it's not like residential real estate where, hey, I got great credit, so I can get it done. They don't care about your personal credit. And honestly, land loans and vacant buildings are super hard to finance because no one wants to do an asset-based loan. Everyone's looking for cash flow. Loans based off of what kind of cash flow that property is generating.
The good news out of that, right, Luke, is that it's not just somebody who's new can't get a loan. It's nobody can get loans on those type of assets. And that's a great story to pitch to somebody who needs to sell a property for a creative finance deal where they hold back a note or a lease or something of that nature, right? Because nobody's getting these things unless, people are coming in all cash.
Deals that were tough a year ago, right now, they're just not getting done at all. Like no one will do them. I mean, there were 20 bridge lenders a year ago fighting over these deals. They'd win a deal by 5 basis points or 1 basis point. It was ridiculous. And then COVID happened and their lines of credit got called. They got margin called and 90% of them left the market. And the only ones that are left are the ones left with balance sheet money. And so it's more expensive. So yeah, and now those lenders are seeing tons of deals. The ones that are left are seeing lots of deals, so they're picky. So the deals that were hard just aren't getting done at all. It's hard. I tell everyone, you're all in the same boat. It's not like someone else is getting special treatment. It's hard for everyone. But I will say I'm signing up. I just signed up a vacant retail deal at like 12% interest recently.
What term?
Just like a 1-year term. This guy does not have a signed lease, but he has a signed LOI that he thinks is going to turn into a lease relatively quickly. And they're just giving him a 1-year deal with some TI money for him to close on the property, get the lease signed, get the tenant in, and then he'll go refi. At least that's the thing.
Talk to us about how important who that tenant is, during this time period, right? I'm sure that not only having a tenant in there, but who is that tenant? Talk to us a little about, the credit rating of that tenant and how that plays into getting a loan.
Obviously, multifamily is great because you have 30 or 40 or 50 or even 10 tenants, so you've got good rent roll granularity, right? If 1 or 2 don't pay, so what? You're still going to get cash flow. When it comes to other types of properties, like office or industrial, where you might only have 1 tenant in the building or 2 tenants in the building, those properties are really hard to finance unless, like you said, unless the tenant is really strong. And so if they have a credit rating, that makes it a lot easier. Lenders want to see plenty of term left on the lease. They don't want to see a building, even if you say, hey, it's a 100% occupied building. Well, if 50% of the building has a lease that's rolling over in 2 years, they don't want to make a 5-year loan that in 2 years could be 50% vacant. So I have some great industrial properties with 3 or 4 tenants, and lenders are just saying, they're all rolling within the next 5 years. We're worried they're not going to re-sign. We're worried about the economy. We don't want to do that deal, even though it seems like a good deal right now. So yeah, tenant, how much money the tenants have put into their property is important, and their credit, if it's a big, national tenant, that certainly helps. And then if the tenant financials are good, they'll do it. I have some lenders out there that will actually dig into tenant financials, and they'll say, if we feel like the tenant has a really strong balance sheet, we'll do the loan, even if it's not a credit tenant. But and for retail, sales are very important. Sales numbers. If you're buying or thinking about buying anything retail, you really want to see those sales numbers and make sure the occupancy cost is low.
That makes a lot of sense to me. That's why I love self-storage. Chris, you got any more follow-up on that?
No, I really appreciate you, Hayden, doing this, and thank you to Luke for sharing your knowledge with us. It's it's a pretty harrowing time right now for an investor as far as trying to get a thing. So I guess what I would like to follow up on is what do you see in 2021? Yeah, obviously we're going to have a lot of turnover, a lot of stuff going, foreclosure and things of that nature. Do you feel that banks will start opening lending, following this bloodbath that's coming, I guess you could say?
Yeah. Hopefully, like I said, a lot will depend on finding that vaccine. So once the election's over, hopefully a vaccine comes out, and I think that credit will open up a lot more. The longer that takes, the worse it could be next year. So yeah, I'm hopeful. I'm optimistic that next year things are going to be more normal and things are going to open up again. But if they don't find a vaccine till next year, and the unemployment keeps continuing at the rates that it's at right now, and who knows, it could be a lot worse. I'm optimistic. I don't think that's going to happen, but yeah, once all these forbearance periods end, and once all the free rent periods end, the borrowers have to start paying these loans back again. And if their tenants aren't back paying them rent and they're not able to pay their loans, then yeah, we could be in a lot of trouble. So hopefully it bounces back quick. But if it doesn't, you're right, there could be a lot of opportunity to pick some stuff up cheap.
Excellent. What about a region? Are you seeing different regions in the country that are doing better than others?
Oh yeah, 100%. So big cities are not doing well. A lot of people are moving to the suburbs. A lot of people are moving back home with mom and dad, or saying, you know, I just had my first kid and I don't want to live in downtown New York paying these rents if nothing's open. Like for me personally, you know, I live in downtown Detroit. Well, there used to be sporting events, concerts, bars, you know, all these activities, and now there's nothing. There's none of that. So it's kind of a ghost town. So do I really want to pay a huge rental amount and have issues with parking and deal with all the hassles of a big city if I'm not getting anything out of it? Why not just go back to the suburbs? So I would say there's kind of been a revival in suburban office, in suburban retail. Obviously, grocers are doing really, really well. But yeah, big cities aren't doing great. And then there are definitely states or areas that lenders don't like right now. Like for example, Vegas is a great example. No one wants to lend money in anywhere near Las Vegas right now. I mean, like anything that surrounds, you know, entertainment is really in trouble right now. And so yeah, New York is not doing well. San Francisco is not doing well. Vegas is really a scary place to lend right now. Yeah, anywhere that's in the news, lenders are definitely going to be more cautious.
Excellent. Thank you so much for your insight.
Yep.
All right, Chris, Luke's going to be expecting an email, and you guys are going to get a deal done. Who else has got a question in here? Anybody? Mateus, you got a question?
Got my roommate.
Yeah.
He can ask me anytime.
Did he read my book that I gave him?
I know that he read most of it. I don't know if he's finished it yet.
Is he getting into real estate investing now? Is he got the wheels turning?
He's trying. I'm always trying, but it's hard to find good deals. There's a lot of competition. Everyone is looking for the same stuff. Everyone wants multifamily, self-storage, and industrial space right now. So, you know, the deals that you want and are the ones that everyone else wants.
Yeah, that's why it's so important to go off market. I mean, when a broker's got a deal, if it's on the market right now, it means it was no good because none of their pocket buyers wanted it, right? Which is
right. Exactly. I hate buying deals on market. I looked at so many deals. I've never seen a deal on market that really makes sense. I mean, it's amazing to me. But yeah, if you really want to find good deals, you see a property that you want to buy, go find out who owns it, call that guy. You never know if you're going to get lucky. Maybe it's an older guy who just wants to get out. Maybe someone died and the wife or kid is managing it and just wants to get out of the deal. Maybe the guy had no idea what it was worth, and when you make him an offer, he says, yeah, that sounds great. I mean, I would say just make that.
Don't say it's rare, man. That happens all the time, and people just they don't know. They're afraid of offending somebody. If I ask them if they want to sell this building, who cares if you offend somebody? I mean, you're not intentionally offending them, but a lot of times you're solving people's problems. A lot of times you show up at just the right moment and they go, this is a sign from God that I was supposed to sell my property to you because I'm having this financial hardship. So that's great. Let's do the deal, right? And you get a deal done that makes sense for everybody. So get out there, start, you know, looking at buildings. Don't just call people. Go knock on people's door. You know what I mean? Do whatever it takes.
I have done very few deals that were on market with brokers. It's almost all, hey, the deals that really work are the ones that people find off market or that people are refinancing and had forever or something like that. It's really hard to find an on-market deal that really makes sense, you know, unless you get really, really good financing. So for example, right now, HUD is the most popular lender out there by far. The last 10 years, no one wanted to do HUD loans because everyone was like, it's too much work. It's too much of a hassle. Now, HUD is the most aggressive lender out there. Everyone else has gotten more conservative, and we can't even keep up with the HUD volume we have. The HUD offices are all backed up. It's taken like 9 to 12 months minimum to get a deal done. And next year will probably be a record year for HUD.
Because they're just printing that money, man. They're just
Nope.
like, let's print it and give it
No one
away.
wanted to do a HUD loan for the last 10 years. We had a HUD guy at my office who was like, you know what? I can't get any deals done. I'm going to go into the private sector. I'm going to go into the other side of things and try something different. Right when he left, HUD blew up. But, you know, it's cyclical how these things work. HUD kept the lights on at Berkadia in 2009 and 10. And, you know, honestly, depending on what happens next year, they're going to be a big boon. I just closed my first HUD deal. So
congrats, man.
And it was,
drinks on you tonight.
Thank you. Absolutely.
So are people wanting HUD because the 35-year AM schedule, low cost of capital, just makes their mortgage constant super low, and that's the only way they're getting deals that make the cash on cash that they want, or what?
Right, exactly. A perfect example. This guy finished building this property. He used a credit union to build it for the construction loan. And he came to me and he said, hey, I want to refinance with Fannie and Freddie, or a life insurance company. The life insurance company said, you know, we don't love the market. It's too tertiary. And then Fannie and Freddie said, yeah, we'll do it, but first time sponsor. So we're only going to be at, one was at 65%. And I think Freddie Mac was at 70%. He's like, 70%. He's like, I thought I was going to do a lot better than that. I'm like, well, you got one other option, and one other non-recourse really good option. That's HUD. And HUD got to 80%. Yeah, 35-year term, 35-year AM. And we locked the rate, and like rates are like in the low twos right now, like 2.3%.
Fixed too, right? No balloons ever.
For 35 years.
Yeah, insane.
But
for people who don't understand, go ahead. I was going to say,
you know, the metrics are great, but the headache, you know, is a big issue. And
that's like SBA loans, or what SBA loans used to be.
Yep.
You know, on the self-storage side, you can go get 90% LTV on an SBA self-storage loan, but it's going to take you 6 months to get that loan. And they're going to want to talk to everybody and your medical doctor to see, are you a good borrower for this? I'm sure it's the same process with HUD. I mean,
they don't do self-storage sometimes.
Yeah, but when that's your only option, I mean, the terms are great, right? So for people who don't understand how powerful that is, you could probably borrow double the amount of money. So let's say, just for comparative sake, if you were to go get a self-storage loan and you were to borrow $1 million, the self-storage, really the most you're going to get is a 20-year AM schedule, and you're going to be at probably 4.25% to 4.5% right now, because CMBSs aren't out there. You're not getting any lower cost of capital than that. So your payments that you're making every single month, you could probably go borrow $2 to $2.5 million from HUD. And because it's a longer AM schedule and a lower rate, because you borrowed 2 to 2.5 times more money, your monthly payments are still the same amount, which allows you to pay higher amounts for that property to get the deal done and still earn cash flow.
Right.
It's insane. So anyways, if nobody else has a question, we're going to let Luke get back to work here, man. So we'll hold here for about 15 seconds, see if anybody wants to ask a question. I guess no more questions. So, Luke, with that being said, thanks, man. I got your email down. Anyone on this call, Luke's email is in the comments right now. Before I log off, go grab it. Also, if you're in my Facebook group, I dropped his email in the comment section. It'll be posted there. Luke, I'm going to post this video on YouTube as well, and I'll post, if it's okay with you, your email and the link in that bio or description, so that everybody can grab it from there. And I hope this brings you some business, and I hope you help some guys get some loans done, or at least educate them on what they need to do, right? So if you guys go to Luke, he's not going to tell you, like most bankers are, he's not going to tell you, no, I can't do this. He's going to say, hey, I can't do this for this and this reason, and here's how we overcome that. Go get this person, blah, 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 do this and this, and we'll be in a position to get you a loan. Now, his saying may be, go find a different deal. This deal sucks. And that's what's cool about Luke, is he'll tell you straight up, this deal sucks. Like, this isn't getting financed by anybody. And you should thank him for that criticism, because he's going to help you and educate you on what is and what isn't a good deal, right? So if you come to him, he's like, yes, we can finance this. You know, from an expert, it's like, this is a good deal right here. So he'll be guiding you down the right track. Any closing thoughts, Luke?
Absolutely. Thanks for everything, Hayden. This was great. Appreciate it.
Cool. Absolutely. Absolutely. All right. I'll see you, man.
All right. See ya.
See you, everyone.